You are looking at your bank account right now, and you see a number like $10,000, sir, maybe even $50,000, sitting there perfectly safe and secure. You probably feel a sense of responsibility and perhaps even a bit of pride because you have done exactly what society and your parents have always told you to do with your money. But the uncomfortable reality that nobody wants to talk about is that you are actually the victim of a mathematical crime. Because that money isn't just sitting there protecting you, it is actually evaporating right in front of your eyes, while an invisible tax continuously shaves pennies off the value of every single dollar you own. You might believe you are building a safety net for your future, but you are actually building a trap that guarantees you will become poorer every single day you leave that money stagnant. By the time we finish this conversation, I am going to show you why your emergency fund might actually be your biggest financial liability. And we are going to deconstruct the banking system that profits off your fear so you can finally stop losing purchasing power. To understand why this is happening, we have to look at the math that banks hope you never actually figure out for yourself. Because their entire business model depends on your ignorance. The average savings account in America pays a pitiful amount of interest that often amounts to fractions of a percent, while inflation relentlessly drives up the cost of living every single year. When you actually run the numbers, you realize that if your bank pays you less than half a percent, while inflation is eating away at 3% or more, you aren't saving money at all. You are effectively paying a 2.6% annual fee for the privilege of letting your cash sit there and rot while the bank uses your capital to make themselves rich. If you have $50,000 in a standard bank account today, that money will likely have the purchasing power of only $37,000 in 10 years, which means you lost $13,000 without spending a dime. This is what I call the silent heist, because the bank takes your money to lend it out for car loans and mortgages at much higher rates while paying you crumbs and letting inflation destroy the rest of your value. The reason most smart and hardworking people fall for this trap isn't because they can't do math, but because their biological programming is working against them in a modern financial environment. We have discussed the concept of the poverty brain before, where growing up with financial instability rewires your mind to treat every expense as a threat and every dollar in the bank as a survival tool. When you see a large pile of cash in your savings account, it acts like a tranquilizer for your amygdala, telling your primitive brain that you have enough resources to survive the winter. This false sense of safety triggers a concept in behavioral finance called loss aversion, where the pain of losing money is psychologically twice as intense as the pleasure of gaining it. You are terrified of seeing red numbers on an investment screen. So you choose the guaranteed loss of inflation over the potential gain of the market because it feels safer in the moment. To truly break free from this mindset, you have to understand that banks are not just storage lockers where your specific dollar bills sit in a vault waiting for you to come back. Banks operate on a system called fractional reserve banking, where they keep only a tiny fraction of your deposit on hand and lend the vast majority of it out to other people. Your deposit becomes someone else's car loan or small business loan, earning the bank 7% or even 25% on credit cards, while they pay you next to nothing. When you hoard cash in a low interest account, you are essentially working as an unpaid employee of the bank, providing them with the raw materials for their profit factory while you pay the inflation tax. The wealthy understand this game and refuse to let their capital sit idle because they know that money must be in motion to grow and that stagnant money is dying money. We can actually put a specific price tag on this fear by looking at the concept of opportunity cost over a long period of time, which reveals the true damage of playing it safe. Let's say you are overly conservative and decide to keep $50,000 in your savings account, just in case, even though you probably only need $10,000 for true emergencies. If you took that excess $40,000 and invested it in a boring, low-cost index fund, averaging 10% returns, it would grow to approximately $697,000 over 30 years.
That means your decision to keep that money in the bank for emotional comfort didn't cost you nothing. It actually cost you over $650,000 in lost future wealth. You are effectively paying the bank hundreds of thousands of dollars over your lifetime to babysit money that you didn't even need to touch, which is the most expensive insurance policy you could possibly buy. One of the biggest reasons people fall into this expensive trap is that they have a terrible definition of what actually constitutes a financial emergency. Most people treat their savings account like a slush fund, where they see money sitting there and think they can afford a vacation or a new couch just because the balance is high. We need to redraw the lines, because a roof replacement in 5 years is not an emergency. It is a planned capital expenditure that you should be saving for specifically in a different bucket. Your emergency fund is not a fund for lifestyle upgrades. It is financial insurance designed to prevent you from selling your assets at the wrong time. Liquidity is oxygen, because when the market crashes and you lose your job simultaneously, the person with no cash has to sell their stocks at the bottom to pay rent, which destroys their wealth permanently. The solution to this problem is not to drain your bank account to zero, but to implement a specific algorithm I call the liquidity ladder to determine exactly how much cash is too much. The first rung of this ladder is your sleep well buffer, which lives in your checking account and covers 1 month of expenses, plus a little extra so you never overdraft. This money is just the grease that keeps the engine of your life running. So you don't care about the return on this money, you only care about the utility. The second rung is your actual emergency fund, which should live in a high-yield savings account earning 4% or 5% rather than sitting in a traditional bank earning nothing. If you are single and rent, you need 3 months of essential expenses. But if you have a family or mortgage, you should aim for 6 months. Once that bucket is full, you must force yourself to stop filling it and redirect every single additional dollar into the third rung, which is your wealth engine. This is where the magic happens, because every dollar that comes in after your emergency fund is full gets deployed into tax-advantaged retirement accounts or taxable brokerage accounts. This money buys assets like index funds and real estate that allow you to own a piece of the global economy and actually fight back against inflation. If you are sitting on a large pile of cash right now and feel terrified to dump it all into the market at once, you can use a strategy called dollar cost averaging to mitigate that fear. You can divide your excess cash into 6 chunks and set up an automatic transfer to move 1 chunk into the market on the first of every month for the next 6 months. This approach works because it removes the emotion from the decision and turns market volatility into a psychological advantage rather than a source of stress. If the market drops after your first contribution, you actually cheer, because next month your automatic transfer will buy more shares at a discount, which lowers your average cost basis. You have to understand that if you are young, your biggest risk isn't the stock market going down temporarily. It is running out of money in old age because you played it too safe. The stock market has historically returned about 10% annually, while inflation runs at 3%, which gives you a 7% real return that builds wealth. Cash returns almost nothing, which means the difference between holding cash and holding assets is the difference between retiring in comfort and working until you die. Executing this strategy requires you to shift your identity from being a saver to being a capital allocator who views every dollar as an employee. If an employee is sleeping on the job by sitting in your checking account, you need to fire them and move them to a department where they have to work, which is your investment portfolio. You need to calculate your monthly burn rate by looking at your last few months of spending and then multiply that by 6 to define your absolute cash cap. If you have any money above that specific number, it is lazy money that needs to be deployed into assets immediately, or it is simply losing value. You must automate this entire process so that once your checking account hits a certain level, everything else sweeps into investments without you having to make a decision. The uncomfortable truth is that comfort is expensive,
and keeping all your money in the bank is a tax you are paying to your own anxiety.
You have to get comfortable with being uncomfortable and get used to seeing your net worth fluctuate, because that is the price of admission for building real wealth. The safety trap lures you in with the promise of security, but it delivers poverty by letting inflation eat the value of your labor from the inside out. Real financial freedom does not come from a pile of stagnant cash. It comes from assets that work harder than you do. So you need to cap your cash and invest the rest. Your future self is counting on the decision you make right now. So do not let them down by choosing the easy path today that leads to a hard life tomorrow. But let's go even deeper into why this mindset shift is so difficult for so many people who have been raised to believe that cash is king. When you look at the wealthiest people in the world, you will notice that they hold very little of their net worth in actual cash because they understand the concept of velocity of money. Wealthy people treat money like a hot potato that needs to be moved into an asset as quickly as possible before it cools down and loses its value. They understand that cash is a depreciating asset, which sounds like an oxymoron, but it is the absolute truth in our modern economic system. Every day you hold a dollar, it buys slightly less than it did the day before, which means you are on a treadmill that is constantly moving backwards. If you are just standing still, you are actually moving backwards, which is why the middle class feels like they are running faster and faster just to stay in the same place. The banking industry spends billions of dollars on marketing to convince you that their savings accounts are the smartest place to park your wealth, because they need your deposits to fund their lending operations. They offer you free toasters or small cash bonuses to open accounts because they know the lifetime value of your deposits is worth thousands of times more than that sign-up bonus. They are arbitraging your fear against their knowledge of how the financial system actually works, and they are winning every single time you leave excess cash in their accounts. You need to stop being a customer of the bank and start thinking like the owner of the bank by becoming an investor who lends capital to the economy. When you buy a stock or an index fund, you are essentially becoming an owner of the companies that drive the economy, rather than just a consumer who buys their products. This shift from consumer to owner is the fundamental difference between those who build generational wealth and those who struggle to make ends meet despite earning a good income. It is not about how much you make. It is about how much of what you make is working for you, rather than just sitting there waiting to be spent. Many people have a scarcity mindset that tells them they might need that money someday for some undefined disaster that might happen in the future. While it is true that disasters happen, the vast majority of financial emergencies can be covered by that 3 to 6 month buffer we discussed earlier. Keeping $50,000 or $100,000 in cash for a disaster that might cost $5,000 is an incredibly inefficient use of your resources. It is like wearing a full suit of armor every single day, just in case someone throws a pebble at you. We also need to address the psychological comfort that comes from seeing a big number in your bank account versus seeing that number in an investment account. When the market is volatile and your investment account balance drops by 10 or 20%, it can feel like you are losing real money, which triggers that panic response we talked about. However, you have to realize that the stability of your bank account balance is an illusion, because while the number stays the same, the value of what that number can buy is dropping. In the investment account, the number might fluctuate wildly in the short term, but the purchasing power is growing over the long term. You have to train your brain to look past the volatility and focus on the long-term trend, which has always been up for the US stock market. Furthermore, you need to consider the impact of taxes on your savings strategy, which is another area where the wealthy have a massive advantage over the average saver. Interest income from savings accounts is taxed at your ordinary income tax rate, which is the highest tax rate you pay. Capital gains from investments held for more than a year are taxed at a much lower rate, which means you get to keep more of what you earn. By keeping your money in savings, you are subjecting yourself to the highest possible taxes on the lowest possible returns, which is a recipe for financial stagnation. Moving your money into investments not only increases your potential returns, but also improves your tax efficiency, which accelerates your wealth building even further. Another critical aspect of escaping the safety trap is understanding the difference between saving for a specific goal and hoarding money out of fear. If you are saving for a down payment on a house that you plan to buy in 2 years, then keeping that money in cash or a high yield savings account makes perfect sense because you need the principal to be safe. However, if you are hoarding money with no specific timeline or purpose, just because it feels good to have it there, you are falling victim to the trap. You need to give every dollar a job and a timeline so you know exactly where it belongs. Money that you need in the next 12 months belongs in cash, but money that you won't touch for 10 years belongs in the market. It is also important to recognize that inflation isn't just about the price of milk and bread going up. It is about the cost of your future freedom increasing. If you plan to retire in 20 or 30 years, the amount of money you will need to support your lifestyle will be significantly higher than it is today. $1 million might sound like a lot of money right now, but in 30 years, it might only have the purchasing power of $400,000 today. If you are keeping your wealth in cash, you are guaranteeing that you will fall short of your retirement goals because you are running a race against inflation with a strategy that is designed to lose. Investing is the only reliable way to outpace inflation and ensure that your money maintains its value over decades. The concept of the liquidity ladder gives you a structured way to balance your need for safety with your need for growth. So you don't have to choose one over the other. You can have the peace of mind that comes with having a cash buffer while still participating in the wealth creation engine of the global economy. It allows you to sleep at night, knowing you can handle an emergency while also knowing that your future is being secured by your investments. This balance is the key to sustainable wealth building because it addresses both your psychological needs and your mathematical reality. You also have to be wary of the advice you get from friends and family who might mean well, but are also trapped in the same poverty mindset. They might tell you that the stock market is gambling or that cash is the only safe place to put your money because that is what they were taught. But you have to look at the results of that thinking and ask yourself if you want to end up in their financial position. If you want different results, you have to do something different, which means breaking away from the herd and making decisions based on data rather than fear. The transition from a saver to an investor is a journey that requires education and discipline, but it is the most rewarding journey you can take for your financial health. You start by building that foundation of safety with your emergency fund, and then you systematically build your wealth on top of it. You don't have to be a genius to do this. You just have to be consistent and willing to tolerate a little bit of short-term volatility for long-term gain. The market will go up and the market will go down, but over the long run, it has always rewarded those who stay the course. Think about the legacy you want to leave for your family and the example you want to set for your children regarding money. Do you want to teach them to live in fear and hoard their resources? Or do you want to teach them to be smart allocators of capital who understand how to make money work for them? Breaking the cycle of the safety trap isn't just about your bank account. It is about changing the financial trajectory of your entire family tree. When you master these concepts, you give yourself the freedom to live life on your terms, rather than being a slave to a paycheck or a victim of inflation. So take a hard look at your finances today and ask yourself if you are truly saving or if you are just slowly losing money. Calculate your real burn rate, define your emergency fund cap, and start moving that lazy money into productive assets. It might feel scary at first to see your cash balance drop as you move it into investments, but that fear is just your primitive brain trying to keep you safe in a world that no longer exists. Trust the math, trust the history of the market, and trust yourself to handle whatever comes your way. You have the tools and the knowledge to break free from the safety trap and build the wealth you deserve. Remember, that every day you wait is another day that inflation is chipping away at your hard-earned money. The best time to start this process was yesterday, but the second best time is right now. Do not let the paralysis of analysis keep you from taking action, because the cost of inaction is far higher than the risk of investing. You are capable of managing your wealth and securing your future, but you have to take the first step. Move that money, automate your investments, and stop paying the fear tax that is keeping you from your potential.